Well, people have so many choices when it comes to their long-term strategy, right? Portfolio management, investment goals, they're not one size fits all. In fact, there are still opportunities that could arise for investors to reallocate their assets in different ways. And so Chance Finucane is with us, partner, CFO, Oxbow Advisors. Chance, great to have you on. Wanted to take a look at the kinds of questions investors should really be asking themselves, because people like to chase some high-flying stocks. What should we know? What should we be asking?
Sure. Well, I think the first thing, Nicole, that we want to focus on is the 60-40 portfolio that you've seen a lot of investors use in recent decades, where you have 60% in stocks and 40% in bonds. Pretty simple portfolio. You get a lot of return from the stocks. The bonds act as a portfolio stabilizer, but you also got some good yields over the last couple of decades. I think today, if you're comparing across asset classes, bonds are so low yielding right now that if you keep that 40% in bonds and still expect to make at least a 6% annual return in your portfolio, it's going to be really hard to pull that off.
So what about liquidity? Cash on hand, some people were putting it to use. We had the March decline, but no way to time the market. Do you have a rule of thumb on liquidity for long-term investors?
Yeah, I think if you're in a situation where you're going to be able to keep a little bit of cash, we usually advise that we prefer to have that flexibility in the portfolio rather than trying to maximize the expected returns in the current period. And we kept a little bit more cash in our clients' portfolios going into the year, and that really served us well in March when we had that 34% decline in the market. You're right that over time you do want to stay more invested, but I think with where valuations are today in the stock market, it's not a bad idea to have a little bit of cash available so that if we do get some sort of a correction, you'll be able to take advantage and buy some stocks at better prices.
Okay. So don't be fully invested. Make sure you have the opportunity to dip in. Managing the risk, that's always a big aspect, isn't it? So what are some things that we should be taking into consideration before taking on even more risk?
Yeah, I think one thing that investors who are trying to allocate between different asset classes or maybe across different types of strategies, U.S. stocks versus international stocks, focus more on high quality companies rather than chasing lower quality companies that just might look cheap on valuation. That might work sometimes in some short-term trades, but over the long run, we believe that investing in superior, faster growing businesses, regardless of where they're located, is going to generate better results. And if you're worried about something like debasement of the US dollar or inflation increasing, then maybe you can have a little bit of your portfolio invested in gold, precious metals companies, or inflation protected securities like TIPS.
So that's actually another area, right? You have to have other sorts of investments rather than just the 60-40 bonds, equities, to have a little bit in alternative investing, right? You mentioned gold. What were some of the others?
Yeah, I think you could probably have up to 5% in gold. You could have up to 10% of your portfolio invested in public real estate or REITs. I think that's a decent diversifier. I know people talk about cryptocurrencies, but I don't think we'd recommend much of your portfolio to be in that. Maybe if you really wanted a part of it, put up to 1% of your savings in there, but that's really not something you'd want as your main asset allocator.
Right. Okay. Because that fluctuates a lot, and you don't want to have too much risk in something like crypto because you just don't know which way it goes. That being said, when you talk about the 60-40 platform, it's really hard to get yields out of bonds right now. Are there certain kinds of bonds that you like more than others? Because some people would say, I don't know about 60-40 right now, because you're going to have a low rate environment for some time.
Yeah, you're right, Nicole. I think it's tough right now. You just saw in the last week that investment grade corporate bonds are now yielding less on average than the expected inflation rate over the next 10 years, which means if you invest in corporate bonds, you're not going to get any better, any increase in your purchasing power. We wouldn't chase high yield bonds either. What we've been finding for our investors who want some yield is that we actually are looking a bit more in preferred stocks. If you can find investment grade rated preferred stocks or investment grade rated mandatory convertible preferred stocks, Some examples there would be Broadcom, NextEra Energy, or Becton Dickinson have some assets like that. I think that might be a better place where you can get a little bit more yield. And then also in that REIT space, there are some healthcare REITs that service medical office buildings and own hospitals that we think could do well there too.
Yeah, preferreds are important. When you talk about dividends, right? When you talk about REITs, I start thinking dividends. And I only have a few seconds left, but a quick thought on putting some dividend payers in the portfolio?
Sure, we'd actually recommend that. We think it's better to be a little bit safer and more defensive in your portfolio and stocks. So probably looking at some of these steady drug companies is the best place to be, or maybe something like a Unilever or a Nestle.
Chance, great conversation. Thank you. Good to see
Thanks,
you.
Nicole.
Chance Finucane, partner, CFO, Oxbow Advisors. Great to have you on and taking a look here at the long-term portfolio planning, folks.